Thank you, Mike. We got to be very careful not to oversell this, largely because we've got some other angel investor, not just angel investor, but previous speakers in the room. So, Chris, you got to be generous. Be careful. So let's have some fun together. I understand, Mike, we got an hour together. I'd like for most of it to be the Q&A, but let's see how quickly I can get through this. I had a talk that was prepared, and Mike made me throw it out. He said, no. I don't want to hear the usual stuff that you say when you're trying to promote the Pasadena Angels. Excuse me. What I'd really rather hear about is the mistakes that you've made along the way. I want to know what lessons you've learned. So I had to throw out the old one and put this one in. So let's start with, how do I do this again, Christy? Like that. So let's start with who I am. Try to make this brief. I'm a refugee from corporate America. I was 28 years at the Times Mirror Company. You may remember the good old days when there were indeed newspapers, even magazines and other such printed materials. And we, over the course of the 28 years I was there, we did about 45 acquisitions. And I started in acquisition analysis and over the years began to do other things. The last 8 years, one of my most enjoyable jobs was working with the CEOs and CFOs of those operating units. We retained the independence and integrity of those companies, and in fact, what we did for the most part was simply act like the board of directors for those companies. So they retained their full table of organization. So I would work with those people on their budgets, cash forecasts, dividend policy, capital expenditures. Some of them wanted to make acquisitions, those sorts of things. And when I got to be about 55 years old, my wife said to me, "Where are you going?" And I said, "Well, it's time to stop working for the man and work for myself." And so I retired early and decided to start investing in little companies. It's not quite as smooth as that, but that's sort of what happened. Now, the second half of this thing, if I know how to do this, Christy, is strategy. Now, that's a whole conversation unto itself, but I'm going to touch a little bit on it, but not as much as we might like. Oh, my gosh. Oh, I'm sorry, folks. I got to leave. I have no idea. Can you turn that off? Thank you. Well, that was brief, wasn't it? So let's talk about what I've done in the way of angel investing. So 1994 is the year that I started this. This is the internet was in its infancy, and in fact, most people didn't have internet access, and there were a lot of things that were just beginning to change. Social media, of course, did not exist, not in today's format, and so the communications process was lengthy and a little more difficult than it is today. In fact, startup companies required a lot more capital and a lot more time. Everything has been accelerated over the years. So much of what you see here in this 120 whatever 7 is stuff that happened just within the last 5 or 10 years. Now, let's see, Jay. Where are you? Jay Goss. There he is, right there. So that's to say that not everything... Well, you're on your way. You're on your way fast. That is not to say that 100% of these companies are just companies. About 4 or 5 years ago, I started investing in funds because people like Jay are a lot smarter than I am, and it's easier to let somebody else do the work. But let me just explain a little bit. I'm not going to get into the strategy today, but let me talk about what this thing really says. Okay, so for starters, let's understand what people like Jay have to do. Quarterly, they've got to report to their LPs their results, and that involves marking to market. The entire portfolio has to be marked to market on a quarterly basis. I'm not, no aspersions cast on you, Jay, but what happens is a lot of the numbers that they have to use in valuing their portfolio on a quarterly basis are numbers that are a little soft, a little squishy. So what I've learned over the years is that it's a lot easier to market with words than it is with numbers, and maybe even more accurate. In my chart, and those of you in the back probably can't see this, but in my chart, there's really only two categories where you know that is mark to market. The sure winners are sure winners because I've either gotten all my money back, and by the way, that's a winner for me. If I get my money back, I won. So the only one here that isn't yet a sure winner is this. What's her name? Pacific Premier. It's a local bank, and they acquired the company that I bought. Well, it's traded in the market today, and it's traded at about 2 times what I invested at. It's way low. It ought to be substantially higher. That's why I haven't sold it. The minute that I get it to the place where it ought to be, I'm out. Because I'm only interested, for this portfolio, I'm not interested in the public markets at all. And I wish I weren't in the public markets. But every once in a while, it's nice to be like that time, that guy right there, because he delivered about 200 times the money invested, and that's nice. Now, the problem is that I didn't get 200 times because you're exiting as you go. But the long and the short of it is that is for sure, and these are pretty much for sure. Now, I say pretty much because even though I don't know if you can see it in the back, can you see it back there, Maggie? No. So that says dead and gone usually means it ain't coming back. But here's an interesting one. This guy sold his company to Intermedia for no cash, and the next thing you know, the nature of the sale was that you have the opportunity to get something if it succeeds over time. We'll put more money in than you could, but if it succeeds, then whoops-a-daisy. How do we do that? Then goodbye. And it takes a minute to do. Anyway, what this is telling me is that I'm spending too much time on this slide. If I get invited back, we could talk about portfolio strategy because that's what we really ought to be talking about. But the bottom line here is that these are the good guys, these are the bad guys, and every month, I don't do this quarterly, I do it monthly. Every month, I jigger these numbers around. I mean these names around as to how you're doing right now, and so I'm on red alert for the next problem that's going to come my way. Okay, so the real subject of this talk, because as I said, Mike forced me to change my talk, is what kinds of mistakes have you made along the way? And I can guarantee you with 24 bad outcomes that I've made an awful lot of mistakes. But you try to learn, and I'm hoping desperately to keep on learning. But I put this one first because I think it really is the most important. I mean, one of the things we say at the Pasadena Angels is pay a lot of attention to the visionary, not just the vision. So when you're looking at an early stage company, you spend a lot of time looking at the market, looking at the product, looking at how he fits in, looking at the competition, all of the elements that the entrepreneur is describing. But very little is said about the entrepreneur except for his or her credentials and wild claims about prior successes or something. Very little is said about their mistakes, and believe me, every one of us makes plenty of them. So I've identified, and in fact, I told Mike that originally I had the names of the companies where some of these events occurred, and to protect the innocent and maybe even the guilty, I removed the names, but. I'm happy to get in and talk about the detail. I mean, here's a situation where the entrepreneur cut a deal for himself. It sounded and looked like it was advantageous to the entire investor group, but the deal that he cut for himself was a lot better than the deal that we had the rest. My clock is not working, so I don't know how far I am. You better keep me alert, keep me awake. No, keep me on time. That's what I meant. So, and things like this company had an enormous risk of returns that they were going to have to eat or resell at a substantially lower cost. Oh, this was really fun. These people took $7.5 million of investor money and sort of left the country. It was really an interesting company. It would have been terrific if anything that they told us was true. Did you invest in that, Dale? BLUE? Yeah. Wasn't that cool?
He's still in the country.
Oh, he's back. Well, let's go get him. We'll go to his house right now. So some people. So at the Times Mirror Company, one of the things that we learned is that if you're an executive, you don't roll up your sleeves and do any work. I mean, you've got other people to do it. I resisted computers for a long, long time because my secretary had one, so I didn't need one. I mean, you get the idea. So those are some of the problems. How far are we into this thing? Because I want to move this along and get to Q&A. All right. So knowing that entrepreneur and what he or she is good at and not so good at and likely to do and maybe forget to do is an important part. But the next thing is to be sure that he or she really and truly understands the marketplace that they're getting into. They can define it. Everybody can define these markets, and with Google now, you can. Jen, hi, glad to have you here. That was a surprise. So when knowing, no, I never forget about you. Knowing the market is one thing, but knowing how your product is going to fit into that market is really, really important. Being sure that you design the product and that it has sufficient flexibility, freedom to change, understanding exactly what's going on in the competition, and boy, oh boy, is that changing. As soon as you begin to achieve a little bit of success, guess who's going to react faster than your wife or husband can compliment you? It's the competition. And knowing what the dynamics are, the dynamics of the market. It isn't just who the competitors are in the product, but what the dynamics and the shifting relationship between costs and revenues. I mean, there's really important stuff that's going on all the time. And this is embarrassing. You know, this guy had such a terrific product. It was really a wonderful product, but the problem is that the market changed so much, and he didn't recognize what was going on in the marketplace, and he fell behind and ran out of money, unfortunately. You all probably know this company because they had great success with the utilities and with the customers. But if you're in a regulated industry and the government doesn't like you, that's a real problem. I'm making it look like I don't make mistakes. They make mistakes. But the fact of the matter is that as an angel investor, as an early stage investor, whether you're angel or institutional, you have to be watching every step of the way, and you got to be as alert as that entrepreneur, and you got to be tuned in with that entrepreneur as to what he or she's doing. So the big issue, folks, is running out of money. Do not run out of money. You can run low on money, but you better not get to a place where your investors fear that you're not going to be able to sustain the business. I was at a meeting last week, and Adam Miller was talking about Cornerstone On Demand and how he couldn't make payroll the following Monday, so they post-dated the payroll checks and told everybody, "Oh, of course not. You know, don't you know that payroll's on the 16th, not the 14th?" Well, you know, You remember that story? So, I mean, bad stuff happens, but running out of money is the worst thing that could possibly happen to you. So you better understand what the dynamics are of your financial model and how it's going to change over time. It's the marketplace. It's all. Oh, that sounds an awful lot like what I had on the last slide. And you know why? Because all of this stuff fits together. Everything fits together. And as an angel investor, the critical thing that we've got to do, most people, after you write the check, you wait for watch the mailbox for the for your payout. In angel investing, it starts when you write the check. You have to be paying attention. Gee, why didn't you let me make my other talk, Mike? It's all about what an angel investor needs to do until guys like Jay come along and take us out, or until they take over and push us out. I mean, one of two things is going to happen to us. What you don't want to have happen is for the company to lose its way before the institutional folks arrive, or before the acquisition. And, sometimes, you're not going to believe this, but sometimes entrepreneurs don't tell their investors all the truth. They say the truth, the whole truth, and nothing but the truth. That doesn't always happen. And I have to say that there are times when we don't see it all. Okay. What happened to my other one? Yeah. Okay, you know what? These two are almost the same. I mean, so every entrepreneur had better be prepared for plan A to fail. You know that's going to happen. I mean, we always start off, we say, how much money do you need? And you can almost be sure that you would double the number that entrepreneur thinks. I mean, he or she, they're worried about their percentage ownership, so they're trying to get by with as little capital as they can, as little dilution as they can, and there's always this little friction that's going on between the investor and the entrepreneur about how much money they're going to need. But plan A almost always doesn't work, or if it does, it works because the entrepreneur is so successful at seamlessly changing that plan. There's going to be obstacles. There's going to be all kinds of things that happen that you never anticipated, that they didn't anticipate, and that entrepreneur needs to know how to get over, under, around, or through that obstacle, and to the extent they can make it look seamless, all the better. But they usually don't, and the implementation of Plan B becomes a big emotional event in everybody's life, and a painful one, I have to say. So that was what I was trying to say there. So if you've got the financials right, and you got the entrepreneur focused correctly, and he or she is doing all the right things, and the targets changing, and their ability to zero in on the new target is right, you've got to be sure that the corporate governance issues, most entrepreneurs do not have a good appreciation for the importance of good corporate governance. In fact, many of the entrepreneurs we see say, board of what? Who's board? What board are you talking about? And they don't appreciate the fact that you were the boss, and maybe you still are at home, but now you've got bosses, you've got the board of directors, and there's going to be a compensation committee, and you're not going to be on it. You are not the chairman of the compensation committee to decide how much your salary is going to be, and there's going to be an audit committee and a governance committee, all this stuff that's going to happen that you have absolutely, you've got a lot of influence over, but you cannot control. And there are all kinds of stories about things that happen to companies that are otherwise operating successfully. I don't know what I meant by no second up. What do I mean by that, Mike? No second up. Yeah. Whatever it was, if you get sideways with your investors, it's your job. I'm assuming that most of the people in this room are not investors. Most of you are entrepreneurs. That's what I was hearing. And you absolutely, the care and feeding of your investors is really important, even if you're not going to get more money from them, because they're going to influence the next money into your company is going to be by people who ask the other folks what kind of experience they had. So some entrepreneurs are very closed lips, and this is one. So we had this company where the founder, we love the company, but the founder insisted that there be limitations on the authority of the outside director. They had an outside director, but they overwhelmed him with votes, and it was painful things can happen. Oh, my God, look at this. I mean, so I've made mistakes and then mistakes and mistakes on top of the mistakes. My wife reminds me of them with great regularity. This is I put the most serious one up front because the funny thing is that while it usually takes a fairly long time for companies to fail, if you're a very early stage company, you can fail real fast. And running out of money is a serious problem. So here's all the kinds of things that you need to be in communication. There needs to be a symbiotic relationship at this early stage. It changes, of course, over time as the company gains its sea legs and internal controls. Do not let the CEO manage both the bank account and the recording of the. Yeah, bad things can happen. Always remember that you. So the entrepreneur isn't focused on the exit plan for him or herself because that's not what they want. What they're interested in is building this company. So some of them are. I mean, some of them are serial entrepreneurs are going to go on to do number 4, 5, 6, or 7. But many of these entrepreneurs really want to stay with the company, whether it gets acquired or IPO or whatever might happen. And so you need to keep them focused on a liquidity event for their early stage. Watch out for what's going on inside that company. How do people feel? You have to be very very careful about that. But your team, it's never a one man or one woman show. There's always important people that are backing them up, and you have to be sure that good things are happening. Leadership is not just automatic. I mean, just because you got the title of CEO doesn't necessarily mean you're a good CEO. All right, you know all this stuff. Where are we going? Oh, yeah, I wanted to say that despite all the bad things that can happen to you along the way, sometimes good things can happen. And Mike and I talked about talking a little bit about my results. So I've lost more than I've had more losers. I've had more losers than winners. But if you can reinvest in ones that are doing well, even though you lost almost all your money on the losers, those winners are going to overwhelm that. So your net on the net is going to be substantially better than what you could achieve in the public markets. When I started this, there was not. I think that's all I have, isn't it? Oh yeah, no. So there also, when I started this, there also was no literature on this subject, none. Now there are not only all these books, and these are written for investors, and these are written for entrepreneurs, and then there's all these blogs and all these people who are sharing the wisdom of what's happening. You should stay on top of that because there's so many good things being said, and I must say to you at the end here that you never know where the next angel investor is going to be. I was in the subway in New York. There was a girl sitting on the bench, a woman sitting on the bench, and guess what? So that's my little talk. By the way, on the results, I didn't quite finish that sentence. You're expected now. We have substantial literature that and evidence that your expected returns should be substantially above what you can get in the public markets. So I don't have a fancy ending, Mike. I don't know what you want to do.
I'll end you here. Stender, that was amazing. That was pretty fantastic of the amount of detail you were willing to share with our group here, and thank you for that. We'll open it up to Q&A. I'm going to hand the microphone to John. This is a great time to ask about what kind of conversations you should be having with an angel, what you can do to get started with it. Not a great time to pitch your startup and get Stender to invest in you right now.
I didn't bring my checkbook. Did you bring your checkbook, Chris? Yeah, good. Okay.
Nope, it's not picking.
Still not picking it? Oh, it is now. Okay. Thanks for the talk, Stender, and sharing some of the challenges that you faced as a angel investor. I'd like to start off with a question. We've had a lot of VCs have come speak recently, and that might be one of them. And a lot of them now are investing in earlier stages, and in some cases what they describe as seed and pre-seed rounds. And that's kind of the territory of angel investors. Can you tell us a little bit about the difference between what a VC, early stage seed investor would look at and what their objectives are versus an angel investor?
Well, our objectives are going to be the same. I mean, what we're looking for is a very attractive return. But yeah, that's a very good question, John. The approach is what's most likely to be different. When I started doing this, the VCs, there were no VCs in this very early stage because the risks were way too high and they were dealing with other people's money and they had to justify it. And most of the VCs had moved up. They'd gone from $5 million minimum to $10 million, and some of them even higher. Then they realized that the angel community, and the angel community began. Remember, I said that when I started doing this in '94, there was no such thing as an angel group, and in fact, there have always been angels, but they weren't called that, and there was no organization to it. It was just an individual who had a lot of money and saw somebody or something to invest in. But over starting, the Band of Angels was 95, Chris, is that right? I think 95 they started the band, and then they came down here. Luis Villalobos came down here and started TCA in 97. We started Pasadena in 2000. I joined in 2002. It was still pretty rudimentary, even back then. So I'm going to say over the last 15 years, institutions have been coming down into this market, and they do it's not fair to say that they do a better job than we do, but they do a very thorough job, and they've got the resources that we don't have. We're individuals, and sort of do what you can. So that's a long-winded way of saying the difference isn't in what they're looking for or the things that they are concerned about. The difference is the way that they go about doing it. I should say another thing about that I think is very good about angel investing. When an entrepreneur gets into trouble, the first person he's likely to call is those angels who took the first risk with him at the beginning. More likely, he's going to call those people and ask for help than call somebody whom he's afraid is going to come down on him and slam him and be worried about how to protect their pocketbook, not his success.
Hi. It would seem to me that in a early stage company, high growth company, marketing strategy and sales process would be very critical concepts. Can you reflect upon your experience, and do you have any tips or heads up, if you will, on how you put together a competent, credible marketing strategy and sales process?
Well, from our perspective, it's drill down, drill down, drill down. That entrepreneur had better have a go-to-market strategy that's very thorough and very detailed. And if they don't, they better get somebody on board who does and who knows that marketplace and knows how to do it. And that's another job that we as early-stage investors have. You need to be there for that entrepreneur. And if you do it the right way and your approach is mutual success, we're here to help each other rather than I'm here to slam you for the mistakes you've made. If you do it the right way, you can help an entrepreneur understand the mistakes that they're making and find a way to fix them. Because, as I said before, our incentives are our objectives are very much the same. The incentives are different, and the incentives will always be different.
Over here.
I'm sort of tagging on with this question with the governance. Most founders or entrepreneurs have this amazing spirit, and they are a bit headstrong, and that is what sort of keeps them going. So do you have like sort of a mentorship with them, because it's really hard for them to take other people's advice?
Yeah, the only thing that I would disagree with what you just said is the words "a bit." They're all very headstrong. There's passion. I mean, they've got a passionate feel about what they're doing and how successful they're going to be. They wouldn't take the risks that they do otherwise. I mean, we've got entrepreneurs who mortgage their home. We had one lady who sold her home to get total liquidity. If you're going to take those kinds of risks, you better be headstrong. You better have a strong idea of what you're doing. How do you deal with that? Everyone's going to be different. Everyone is a little different from every other. And sensitivity, so one of the things that a problem that a lot of people have is getting outside themselves and understanding how other people see you. How do people see the way you react at a meeting, or the way that you initiate a meeting, the way you drive a meeting? And I think that's really, really crucial. It isn't just a matter of being nice. It's a matter of having an awareness of where people are seeing little cracks, seeing weaknesses in who you are and what you are, and reassuring them that you're going to find ways to fix it.
Okay, great.
Is that
Got the next question back here as well.
So just to flip maybe your presentation a little bit.
Good. That's all what I wanted to do in the first place.
What are the red flags or maybe subtle red flags that entrepreneurs should see in angel investors that may not be a good fit?
Well, remember, now what we have is these angel groups. You still have individual investors. Dale, for instance, does a lot of things on his own. I mean, no, not John. I'm talking about this guy right here in the front, who's here critiquing my work. So most angels that I'm aware of, as a matter of fact, that book that I told you, here's the best book of all, is this guy right here, because what he says, this is a professor of finance somewhere in the Northeast, I've forgotten where, but what he says is, you angels are taking crazy risks and you have no idea just how dangerous this territory is. And he's right that you do. Angels have a style and a method. Most groups, what have we got? 250 angel groups, I think, in the country now? Something 300, over 300 angel groups. And a group, just like a company or a family or anybody, you develop a culture. There's a corporate culture that develops within an angel group, and they have personalities and styles. Some angel groups are very tough on their entrepreneurs. Some are way too soft on their entrepreneurs. Some are like Goldilocks' favorite bear. They're just right in the right place. So I'm not sure what more to say about that other than we're all different from one another, and the angel's job after writing the check is to either you're going to serve on the board, you're going to be an observer, you're going to be in touch with the CEO, you're going to talk to some of the people in the organization, you're going to talk to other investors who have also invested with you, or people who looked at it and decided not to. I mean, there's a lot of information out there about how and what you can do to influence that entrepreneur's. Does that answer your question?
All the way to the back.
Okay. You had your hand up right from the beginning, didn't you? Oh.
Test. Hi. Great presentation. Thank you. I have a quick question. You mentioned internal controls. What is the most egregious internal control deficiency that you run into, I guess, most often? And what?
Well, I don't know about the most. So luckily, we don't run into the most egregious ones most often. But yeah, there are the most egregious one is the one that I pointed out, where the same individual is collecting the money, that's accounting for the money, and is talking only to the banker. That's it. Nobody else is getting in that, busting through that little communications channel. And then all of a sudden you discover that the money wasn't spent for exactly what you thought it was going to be spent for, or that the money disappeared along with the entrepreneur. Here you are. Okay.
Thank you very much. We really appreciate you being open like this, and it's helping me, especially as a...
My wife is not here, so I can...
I understand that as a consultant and my founder that I'd like to introduce you to afterwards. But the question I have is, how do you personally decide how much to invest in each startup?
So they all have minimums. The good news is that with the advent of digital cap tables, those minimums have come down. Actually, market forces drove them down in the 2008 downturn. People who had minimums of 50 or 25 found that they weren't getting angel money, that they had to go only to the institutions because the angels weren't playing at that level. But as an individual, my decision is I told you that no, maybe I didn't tell you. So let me tell you now. My philosophy, and it kind of came to me over time, it wasn't, is there's no way you can pick a winner. You cannot identify a winner at this stage. You certainly can after they get to cash flow, break even, and they stop worrying about tomorrow and start thinking about next week or next month or next year. That's when you can identify the people who have the ability to go the distance. But at this stage, a company is so fragile that it's a lot easier to identify the losers than it is the winners. And so what I do is I write the smallest check I think that I can write and still get in the deal. And because I want to be in as many deals as I can be in, because there's no way you're going to know which one's going to get you 200 times your money or 20 times your money or even get you your money back. So make it small, get diversification. That's why at the Pasadena Angels we introduced a fund, is to help the first time the new angels get diversification immediately, to give them more confidence and more comfort that next check that they write or the next 5 checks they write are going to be somewhat safe. You must know that more than half of your what's the professor's name up at Willamette? Professor Wiltbank has written a lot on this subject, and in fact, I think that he's done a lot of work for the Angel Capital Association, and they have a fabulous website that's got all kinds of information on it. And one of the things that Rob suggests is that you should expect that a very, very large share of the companies that you invest in are going to go broke.
Good morning.
Oh, there you are.
Hi. Thank you. So one of the common themes in your presentation was the integrity of the leadership within these entrepreneurial startups, and then also the integrity of the marketing strategy as well. So what are some checks and balances that you put in place to kind of make sure that you know the leader of the company that you'll be investing in?
I need you. This lady needs to be so checks and balances. We don't have any checks and balances. We're just winging it. That's what angels are. We are asking that the entrepreneur. That's what we demand of the entrepreneur. You've got to have careful monitoring of all the events, and you got to understand what the dynamics are of that P&L. And how the P&L is going to affect the balance sheet. because every industry and every company is going to be different from every other, and you're going to need different kinds of benchmark. I don't know about checks and balances here. I mean, checks and balances in managing your cash is important, but here it's a matter of monitoring, watching carefully what's happening, and changing the discipline to accommodate the changes that you see in the marketplace. You're going to know very quick if your entrepreneur isn't providing you or isn't doing his own statistical analyses on a regular basis, and in many industries it's daily. It isn't weekly; it's daily. If that isn't being watched carefully, there's problems. So the check is get them going. Make it happen. I don't know if I'm answering your question. I'm telling you, the question you asked doesn't really have an answer for the angel. It does for the entrepreneur.
Back here, Stender.
Hello.
Some entrepreneurs are extremely protective of their IP, intellectual property, or secret source. It's pretty well a no-no that VCs will not sign non-circumvention agreements, but do angels differ in that regard?
Well, I can't speak for the 300 groups. I don't know what all angels are willing to do. And individuals may decide that they're willing to sign something. But angels, just as a general rule, angels don't sign. So the problem is that we got how many lawyers in the room? Who's a lawyer? Come on, fess up. You're there. I know you're there. You can't hide under the table. So lawyers have so much fun suing people. I mean, it is just a joy. It's true. So, no, non-competes and non-disclosure agreements. I love the word you use, though. Hit me again with that. Non-circumvention. Sounds dirty. But yeah, but whatever. I mean, we typically do not, to the extent there is a typical. Where are you going, Dale? Come on, you can't leave.
All right. Hi, Stender.
Oh, Jen, I know you're going to have a nasty one.
No, it'll be easy. I was happy to be on the too soon to tell list.
Well, so let me.
I was really hoping I was
so
going to
you got
surprise you
back,
here and end up somewhere you would be embarrassed about.
You got back to too soon to tell.
Oh, I was moved around recently.
Oh.
So you don't know this yet, but I just got a term sheet.
Look,
So
here I'm anticipating October 31st. October 31st is next Friday, I think. I'm not sure. Anyway, so this is what happens as I approach the end of every month. These people move. And you, my dear, are...
I was too soon to tell on the slide.
Don't ruffle me. November 1st is coming, Jen.
All right. So
Okay,
my
go ahead.
question is, we did just get a term sheet for our first institutional raise. So make note.
Brava.
Thank you. So how can I be a good steward to the angels in my deal? What's the best practice as we raise future rounds to take care of the angels? Should we be offering them the opportunity to get an earlier exit, or trying to negotiate with the VCs on their behalf, or kind of what are my responsibilities as the entrepreneur?
So step one is to tell you send an email to your angels as soon as you've got the deal. I mean, and matter of fact, you can even do it beforehand, but you're going to need to be vague. But as soon as you have that deal, let your angels know what it is and the terms of the deal, and then ask them what they like. It's just a broadside, and it doesn't take an awful lot of time to do that either. And you're going to find some people who want to exit, some people who want to participate, who'd like to tag along. And so there's a lot of people who are simply going to respond, "Congratulations, that's great news, love it," and they'll just let it ride. But there's people who are going to want different things. You can't accommodate everybody, but I have to tell you, letting them know that you care about them and that they're still in your vision, your field of vision, and you're paying attention is an important first step. Some Who knows?
Hi.
Yes, sir.
My name is Chung Yang. I share same experience with you. I worked for a private equity group that bought newspapers, and we sold them. We bought one from Media General, and we sold them for 10x. That's one of the Warren Buffett's deal. My question for you is, do you see certain industries that angels favor, certain sectors, while others are not so much? And what do you do? Do you do deals that require deep domain expertise, like biotech, pharma, or you stick to more easier to understand industries for you?
Good question. I mean, these are all good questions. What am I saying? Another good question is what I meant. Can we spend about 45 minutes or an hour talking about newspapers and why they're failing? I mean, it is so sad. And in fact, I didn't say it, but I took early retirement because this was a newspaper who didn't get it. They thought the internet was a passing fad. Oh, this won't last. This won't last. So, yeah, one of the things you discover is the importance of knowing what you don't know. And this is why people like Jay Goss have a specialite, because it takes deep domain knowledge and experience. And what Jay does that a lot of institutions don't do is he draws his LPs in and makes them work. He puts the LPs to. Is it okay for me to say this? I'm not violating your IP or anything. So the LPs participate in the analysis, the assessment of the companies that Wavemaker 360 is thinking about investing in. Most don't do that, because the depth of the analysis in special industries like healthcare and medical devices and such, and the amount of money that's required to get you from both time and money to get you from here to something that you can exit with, is a real challenge many times. Now, the answer to your other question about, did I answer that part? I'm not sure. No. The answer is for the most part. Now we have people who know stuff like Chris could spend 2 hours talking to you about marketing and sales strategies and this industry and that industry and the subtle differences between them and so on. I mean, yes, there's angels who know some stuff, but for the most part, we are just kind of generalists. And we don't. I would say that the thing that's in favor right now is recurring revenue. If you've got a SaaS company that gives the investors confidence that your churn rate is not going to be off the charts, and that you've got a steady and growing stream of revenues, that's really in favor. And of course, the multiples that you're going to get on that are substantial. It's interesting how sometimes these institutional investors ignore things like profits. Oh, who cares about profits? Profit's not important. Let's just get the revenue. So, there isn't an easy answer to that. What I've invested in is everything. I mean, Jen does car seats for children. She starts off by scaring the hell out of you. So, Jen, what is the number one cause of death for your child is going to be that car seat that was installed incorrectly when you went to Hertz. Scary stuff. And it works, doesn't it? Good going. But she cleans them and she does all kinds of that's even scarier, looking at some of those car seats. I see a question way in the back, John. Do you know? Oh, hey, okay, here we go.
A bit more of a practical, mundane question, perhaps, but you started to touch on it. So it's about the investment process, like analyzing opportunities, and then once you've invested, managing. I'm kind of curious, you're a guy. I guess you're working with some gentleman over here, but do you have a staff that works with the Pasadena Angel Investing Group? Do you have a staff that works under you? But again, that process of I work in commercial real estate investment. I look at 100 deals before I invest in one. You probably have a similar pipeline, but then once you've written the check, then you have to manage that investment. Engage the entrepreneur and so forth. Just if you can talk about that.
Well, you just gave my your question had the answer in it, except for the part about having a staff. I mean, no. Yeah, I mean our staff is the other angels. I mean, we share ideas. That's you can see the wings right here. The angelic aspect of this business is genuinely caring about the entrepreneur, about the team. Caring about those people. Because one of the things that we're thinking about is where is he or she going to be next? Because 28 years for me was a very long time, even though it went by fast. But most people are moving quickly, and so you spot talent and you want to keep them, keep them engaged for you. But no, we angels, for the most part, I'm not aware of any. Well, wait a minute. That's not true. That group up in Boston, remember those guys that we saw at the ACA? They had a professional and they were managing. See, what we do at Pasadena, and I think this is true of Tech Coast Angels, the people that you'd see around the LA Metro, is we invest our own dollars. This is not writing checks that I'm making the decision for somebody else, kind of like the way institutions do. So we're writing our own checks, and you have to do the work yourself. You got to roll up your sleeves and do the work. Or Dale knows a lot more about some of this stuff than I do, so I go to Dale and ask him, what do you think about this one or that one?
Thank you.
Back here. All the way in the back.
All right, here we go, John. Where are you, John?
I'm right here.
Thank you for sharing all this information. My question is, since the talk is about mistakes and failure, what is your approach and attitude about entrepreneurs who have had mistakes and failure, and how do you help recognize how they can turn that into learning that can make their next startup hugely successful?
Well, I can't find it, but you saw the word lessons learned on all of those individual slides about mistakes, because what you caught me doing, I thought artfully, but maybe not, was trying to blame my mistakes on other people. I mean, and you know what? There's an awful lot of that happens out there. And so learning the lesson, being on top of what might happen next, and collaborating with other people who have a reason to care about that is as good a way as I know. I'm not sure I'm answering your question. Hit me again. Refine that question, will you? John, give that lady the microphone.
My question is more about entrepreneurs that come to you and say, we're passionate about this business. Yeah. We had another company before. It may have been in your loser category.
Okay. So this is the art form. I mean, did they really? I prefer an entrepreneur who's been down that road before 2 or 3 times. That doesn't mean that a first-time entrepreneur isn't going to be terrific. But an entrepreneur who's been down the road, whether they were successful or not successful, is not as important to me as whether they learned the lessons from the mistakes that they made or that they allowed others to make. I mean, Harry Truman wasn't the only guy who said the buck stops here. That entrepreneur is responsible for all the stuff that happens in his or her shop, and so there are failures that can produce a more likely to succeed next time for that entrepreneur, but it's all a question of what do you see, and you have to have a relationship with these people. You're not going to get it by in a quarterly report. That isn't where you get it. Oh, good.
First, I want to know if Jen puts pictures of her investors' children in your pitch deck, because that would be awesome.
Better than that. And those kids, it's so fun the way you put them to work.
My question is around making a mistake on not investing in a company that ends up being a winner. And do you have a FOMO about that, and how do you deal with that?
You kick yourself. Oh, yeah. That happens to me less than probably most, because I do tend to write more checks. Small. They're small checks, but I tend to write more of them. But yeah, no, that's exactly right. We have some companies that come through, and for whatever reason, you don't get on board. It's more likely now than it was back then, because we used to take 6, 8, 10 weeks from the time you met the entrepreneur until the time that you actually were writing the checks. Now that time's been telescoped, and it's going to be telescoped even more. I mean, we because the entrepreneurs drive our decision, and they say, "Hey, I'm looking for the angel group that's going to be responsive." That's what they want. They want people who not just write the check, but are going to write the check timely. So you got to move along, and that means cutoff dates.
One last question.
Is that it?
Yeah,
one
more. Yes, Don Lear.
The international Don Lear.
Yes.
Yeah, got it.
My question.
And the real estate Don Lear.
You don't use
a lot of businesses, Don.
I know it.
Yeah.
I'm very busy.
Yeah.
Retired CEO from Noggles Del Taco.
And that too. We didn't hear about that part.
No.
Okay.
Anyway, I know you don't utilize a home office. That was one of my questions, and you sort of covered that. You handle everything yourself pretty much. But do you guys share an attorney and a CPA and whatnot between the investors?
So, sometimes the investor is going to pick the these CPAs. Oftentimes don't come along until that company gets a little further down the road, and that's one of the things you got to watch out for is who's keeping the books, and are they? They're not cooking those books, but the attorney might be selected by the entrepreneur, might be selected by us. It might be that we each have our own. That the company is going to have their attorney, and we're going to have the docs reviewed by ours. There's more systematic. These deal terms are now getting, it used to be the Wild West, and now deal terms are getting much more standardized. That home office thing is kind of an interesting question. We don't have any. We tried to attract some people to the Pasadena Angels who are home offices. I don't think we have yet. Maybe Dale, maybe you're a home office. Are you? No. I might be kind of a home office because I write checks out of four different accounts. My wife and I have a 401k that's self-directed. We have the family trust that the kids can't wait to get their hands on. And then I don't sleep well at night, So, and then I created this little LLC that really is for the children and the grandchildren. And we have, because we have a family operating company, we have a profit sharing plan that each of the employees is a participant in. So I write a check here, there, and there. So I'm kind of like a little informal family office, but
I just wonder how you manage your
portfolio. Badly, but as carefully as I can. I try to be attentive. I mean, that's the important. Being attentive, but it doesn't mean you have to spend every waking hour of the day. It means you talk to other people. I mean, we've got a half a dozen Pasadena Angels in here. These are the people that I rely on. No, maybe they don't rely on me.
Nice ending. Stender, thank you so much. That was amazing.